This isn't exactly a bullish upgrade to your forecast. You still see declines for the full year.
Yeah, look, we came out at 57.30, and clients who know me know that I'm very kind of quantitative and nerdy with these targets, right? And we have 5 different models that we look at right now, and 57.30 is the median. The 2 more bullish ones are our cross-asset model, where bond yields have been on the move, so that one makes me a little queasy right now. But also sentiment, that could also get us more constructive, and we have different ways we're looking at that, but maybe 63, 6,400. That would really, in my mind, be the bull case. But the problem is sentiment is melting up so quickly. My model is rapidly exiting attractive territory. So I don't know where it's going to be in a couple of weeks. I don't want to bank too much on that. When I look at my 57.30, that's probably, my analysis that I'm most comfortable with right now, and that's our valuation and earnings modeling, where we're baking in 1.3% on GDP. We're baking in a few cuts from the Fed starting in September. We're baking in 10-year yields moving up, but then going down to 3.8%. And we've got a little bit of margin degradation in the back half of the year. We think that's all a pretty reasonable scenario to look at, and we've got inflation in the high 2s, not the mid 3s. So we think things are better than when we went to 55.50 back in early April. But I'll tell you, Lisa, after we got that China-U.S. de-escalation a few weeks back, I got a lot of questions. Well, why aren't you just putting on your January target? Why aren't you just going back to 6,600? And I just said, look, we're not back to where we were economically or in terms of the broader macro backdrop back then. And I thought that was an important point to emphasize.